Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Prime Vision Network. So I apologize today. My whole family is sick at this point, so I was lucky enough to catch whatever my oldest has. It's not COVID, we did confirm, but it is a nice little cold, so just bear with me. On today's EIA show, we're going to break it down into our normal three parts in terms of an overview, U.S. refined products, storage, demand, what do we think going into shoulder season, and then in segment 3, we're going to talk about OPEC and what's coming up next week, and then we're also going to look at what does it mean for U.S. products, U.S. sales, U.S. exports, and then how is that interacting with the global market. So when we first start with just the overview of kind of where these numbers are, based on what the API had last night, we were expecting a build. We had been expecting a build over the last week or two. It was just a matter of timing. When do the imports show up? When does the EIA recognize some of this Gulf of Mexico that has come back? So here we are. Like, this is and to be clear, this is a very normal increase, and we'll talk about why it's normal in a second. And then when we look on the product side, we're going to start to see a little bit of a creep up, just in terms of, we had one little push on the export side. Some of that is that makeup that we were talking about with Nicholas, with some of the issues with the ports and the Houston ship channel. That is now cleared, so we should see some of that normalize. But again, this is just going to be a matter of, I think, something very normal, if you will, as we kind of go forward and we look at this on a seasonal basis. Just to see what does this mean? How is this going to interact with what we were expecting? And then what do we expect to continue throughout the remainder of shoulder season? So now when we just turn to the total crude, so you can see we had a little bit of a build. We had a build of about 4.58 million. That's still 47.9 million off the 5-year average. But when you look at this chart here, you can see that we're just starting to move. When you look at 2018, when you look at 2019, when you look at 2015, this is a very normal pivot point in terms of when we start to see these builds. Now, we know that we've had OSP cuts, or official selling price cuts, across the board from the Middle East as well as West Africa, and that has kind of helped pull some of this capacity and this crude into the U.S. market. Then layer that with the fact that distillate is in a much better spot than gasoline. And what do we have coming up but winter? So where are we going to try to focus on? And it's going to be on the distillate cut, not as much on the gasoline cut, which we need heavier oil for, which we have to import. So that's why we continue to see an import-heavy backdrop, given where WTI pricing is and where our demand is going to be and where pricing is on a global level. So again, that's going to be that steady flow, but unfortunately, that also means it's lumpy. And when you look at, Saudi Arabia imports increased 41%, but then when you look at Canadian imports were down 600,000 barrels a day, which is, again, something that we've been talking about as of the last week or two when you look at Line 3, because as Line 3 comes on, that's going to be that very steady increase in imports from Canada into PADD 2 and PADD 3 as we go through the remainder of the year, and it's supposed to come on in the next 2 weeks or so. Apparently, or so I've heard, that they're in the process of line fill, which will then they'll start filling it up, testing the backdrop, testing everything, and then you'll start to see that come through completely. So one of the things that we also wanted to look at when we're talking about this is the days of crude supply. So when you look at where things sit right now, we did have an increase in storage. We had a small increase in refinery run rates of 60 basis points. So we went from 87.5 to 88.1. One of our view at the very beginning when EIA was coming through, our view is that we were going to obviously get that big drop, but then again between 87 and 89%. Last week we saw that 87.5. We said there was a chance that we could get one little bump left before we start seeing some of this reduction. But given where we sit versus historics, this is typically where production, utilization rates are for this time of year. So it's very normal to stay here. And now we'll go sideways a bit. As we said about 4 weeks ago when EIA was coming through and then the damage was assessed, a lot of some refiners delayed turnarounds from the end of September into October. So that'll keep us a little bit more active than normal. And then we'll have that catch up in October when some of these assets come down. which again is just going to adjust days of supply, because you're looking at commercial inventories and refinery run rates to see what that marriage is. So as we kind of stay at this steady level, and then we have these kind of consistent builds going forward, and again, just along shoulder season norms, that's where we're going to see some of this, some of the days of crude supply coming up, which you can see just how elevated they are versus other periods of time, just given where we are on the refining side. So then when you look at U.S. commercial oil storage, now this is looking at oil storage end products. So we're looking at distillate, gasoline, residual, as well as jet fuel, and then in crude. And you can see we're starting to balance out, starting to see that pretty that steady increase. And as we've been saying over the last 2 weeks, as you saw the pace start to slow, it's just we're coming into that seasonal point in time. And when you look at 2018, when you look at 2015, this is kind of that steady move up. And then you'll see as we go forward, we expect to see kind of this slow grind as we move up, just with the additional products coming into the Atlantic Basin and into PADD 5. Because one of the things that we've been saying is that our imports of products will remain elevated. And based on what's happening in the floating market, what is projected to come to the U.S., that will remain the case and keep this fairly elevated. Gasoline storage had a little bit of a pretty much a kind of a sideways move. Storage was up 190,000 barrels. So nothing too crazy one way or the other. So that's one of the things that we're going to continue to watch. We're about 6 million below the 5-year average. But as we keep talking about blending components being that a better kind of tell for where some of this is going to be over the next few weeks, you can see blending components were up about 1 million barrels, and it's only 1.4 million off of that 5-year average, which is something to watch as we go forward, as European gasoline arrivals fell just a bit. You had a little bit of a reduction where it came in closer to about 343,000 barrels a day, but again, there was enough to kind of offset. And then we're based on where we sit right now on imports versus historics, it's very we think it's going to be very consistent at this juncture. Imports did fall 92,000 barrels a day, but we went from 1.08 million to 989 million. So 989,000. So we're not talking about a huge drop. And the delta was from PADD 5, where PADD 5 had an increase of 163,000 barrels a day, which is what we were expecting when you look at some of the timing delays, and PADD 5 is going to provide some of that lumpiness. But again, it's going to be that pretty steady imports as we continue to have a record amount of products coming from Asia into PADD 5. Now, when we look at distillate, this is again the kind of the stronger part. As we've been talking about, distillate, diesel in general has been the bright spot over the last, at this point, 12 months. So, and you can see just how much in terms of where we sit right now. There was a little bit of a build. The build was 380,000 barrels in total, but you're seeing that shift in terms of production. So when we look at refining production, you had about 55 basis point increase of gasoline, but you had 1.14% increase of distillate. And that's where we continue to see some of that pivot as they try to capture the fact that there's a lot of available capacity, and you do have that additional demand as we go into a fairly tight winter months. And that's going to be something we're going to talk about in more detail as we go forward, because we want to look at what is going to happen with gas to coal switching, gas to oil switching, and where do we see some of those pivots, and not only just at what price, but also on a global level, where could we see some bright spots for additional demand? So now when we look at jet fuel, it's fairly stable. The demand levels remain fairly fixed. And when you look at just kerosene and how it can go into the disti pool, that's where it's just going to be, if distillate is going to yield the most, they'll just essentially not recover some of this jet. Instead, they'll just leave it in the disti pool, try to capture the better margin, and then if they see some of that benefit, they can recover it and push it down into the jet fuel side. Looking at the WTI crude futures curve, still remaining robust. We're still above 65 through 2023. So then when you're above 60 through 2024, so again, you're seeing a lot of support in terms of where things are at the moment. You can see that the whole curve is really shifted to the right, which is just increasing the, how long we're expected to be at these specific levels. Protecting some of the profitability of some of the U.S. operations, and especially when you start looking at 52-week price records for LPG, propane, butane, ethane, and some of the things that we're going to talk about more in segment 2 and segment 3. So when we turn to COVID, just to give a brief update on cases, things are moving in the right direction on a worldwide level. U.S. continues to move down. Then when you look at Europe, UK, things are a bit fixed in terms of, not too much moving up or down at this point, fairly stable, while India continues to move in a positive direction. And then on an even better front, when we look at Asia Pacific, you can see that there's been a fairly sizable drop in Japan, in Vietnam, Malaysia, Thailand, and South Korea. So we're starting to see some of those movements. Obviously, Japan has seen the most drop, which is a good thing when you consider where they are in terms of just the size of the economy. But as we're going to talk about in the Econ show, even though they're in a better position, the leading indicators are actually getting a bit worse. And that's something that we're going to want to talk about when we review some of the underlying data sets. So now as we break down some of the different storage levels, here you can see that we had that total storage of 4.58 million barrels. It's still 47.9 million off the 5-year average, but again, we're starting to come into that period of time where we start to see this acceleration. And as we've been saying, PADD 3 was going to see the biggest increase because we do have that slowdown in exports, given that we're very expensive versus Dubai versus other Middle Eastern and Western African entities. And then when you start to see, obviously, our exports slowing, you're going to have about another 200,000 barrels a day of production come in, even though the EIA showed 500,000 barrels a day. We still have another 200 that has come back since. So you'll see that addition as well. We had a small draw from PADD 2 of 20,000 barrels. And then when we look at PADD 5, a small draw of 200,000 barrels. But PADD 4 and 5 is pretty close to kind of that normal. Same with PADD 1. PADD 5, remember that lumpiness in terms of where some of the production is going to come from, where how the imports come through. That's going to, again, take some time. But when we look at Cushing, as we were saying, you're going to get some of this lumpiness, but now you're going to see this kind of gradual increase in storage with an increase this past week of 130,000 barrels. Still 15 million off of the 5-year average, but again, the trend is going to be up. And as we've been saying, it'll be fairly soft in terms of what that pace is going to look like, but it will be positive. Then once you look at the amount of crude that came out of the SPR, or the Strategic Petroleum Reserve, it takes what the build was from 4.58 million to 3.7 million. So again, there's just that little bit of adjustment, that swap that we've been talking about. But that's good. Again, it's a swap, so it should come back. But it'll just be a matter of that, just with that we will have more draws coming out of SPR going forward. So then when we look at land storage, you can see that we're still bumping along the bottom when we look at the totals. West of Suez remains the biggest driver of it in terms of where we are versus normal. We're still above that 5-year low in terms of where we are in the cloud. But as we've been saying, we expect to see this kind of a gradual turn up. And if you look at where that 5-year average is, you can see that it kind of flattens out, then starts to go up. We expect to see something very similar. We just think that the pace is going to be a little bit stronger as we go to the upside, and we will run back into that 5-year average over the next 2 months. Then when you look at east of Suez, we're just sucking right very close to that 5-year. We don't see too much change in that. We actually expect it to go a little bit above the 5-year average, with east of Suez kind of that overhang that we've been talking about versus west of Suez. And it's really driven based on how much is sitting on water and where we expect their demand to be over the next couple of months. And here's where we're looking at that floating storage. So even though we have that onshore situation on an offshore basis, we still have a lot of capacity, a lot of barrels still waiting to come on onshore. So when we look at west of Suez, we're kind of essentially right along the same lines as 2020. We expect to see that to increase over the next few weeks as additional shipments come into the U.S., increasing the amount of Gulf of Mexico floating storage. And then when you look at Europe and we look at how much production increased in Norway, in Europe, and again, just the North Sea in general, you're going to see some of that come back in terms of west of Suez, just given the price. Because right now you'd rather pull from the Middle East and West Africa than from Brent and WTI. So you'll see some of those levels just remain a bit elevated. And then when you look at east of Suez, we're starting to get some of those cargoes, as we said, that had to move out of the way for Typhoon Shanthu. Now they're moving back, and that will, again, just put more crude back in, or recognized as floating storage versus in transit or other. Then on the other side, when we talk about east of Suez, there are a significant amount of reductions in electrical capacity, electrical generation, and it is impacting some refining. So not only is it impacting some ports, but it's impacting refiners. So again, you're going to see some of these issues just putting more crude on the water and just delaying how it comes on shore. Then when we look at the movements on the road, here you can see Europe continues to be strong, starting to roll over a bit, but not by much. We expect that Europe to remain fairly robust, as China did see a fairly marked slowdown. We will see China have a little bit of an increase just because some of the recent outbreaks have now passed. On COVID. So now you have the other issue of, you have shortfalls of electricity, you have issues in industrials, so that's going to keep things fairly capped. And then when you look at rest of Asia, we're getting right back to where we were prior to the most recent increase in cases, which again is just going to kind of delay where we are. We're not going to go back to the lows. We're not going to go back to we're not going to break out to new highs. You're already starting to see it kind of level off at these levels. And that's something we expect going forward. Now, when we look at North America, you can see that North America has essentially flattened out. And remember, this isn't really North America, it's really the Americas. So we see this kind of, again, on a seasonal level, we just expect this to go sideways at this point. There's enough activity on the weekends, keeping us fairly robust, and then the weekdays will keep us, capped at this just below the normal when we look back through 2016 through 2019. So now as we pivot into the different pads, we want to look at pad 3, which again, we expected to see an increase as those imports showed up. Exports remain fairly capped. And you can see when we turn back to 2015, 2018, 2019, this is right where we see kind of this pivot back up when you just look at, again, seasonal. And as we've been looking at these numbers, there really wasn't anything bullish or bearish about them. They were very pedestrian, very much rudimentary for this period of time on a seasonal basis and you can see just kind of where that pivot point was. It was either last week or the next week. But we're right in this range where we start to see these increases as we see, builds. And we expect pad 3 to continue to be the driver and see those additions as we continue to see, obviously, exports slowing, imports increasing. So then when we turn to Cushing, here you can see we're right at this, the blue line, which is a bit hard to see, is right on the average. We expect to see this start to pivot up a little bit, and then we expect it to take out that recent high that was in September. It's just going to take a bit more time to do it and just essentially get us back to the 15-year average as we have those imports coming through, WTI kind of being held off and stored in Cushing. And then if you look at just the backwardation setup, are we going to start to get a little bit of a contango to try to incentivize additional storage? That's where we're going to have to look at what that curve is going to do over the next few weeks. Right now, that is not the case, but it's just in terms of trying to keep some of this in Cushing as we have additional imports coming through. So then when we start getting more in depth into the runs, here you can see, as we were saying, we went from 87.5% to 88.1%. So it's funny because sometimes the crude oil run, it can increase bigger than others, and it depends on, again, what kind of crude is being run through, because depending on some of the processes, they're actually carbon negative, so you'll need additional crude to do it, or depending on which way you're going. Again, we just saw 67,000 barrels additional run through. And you can see there was a drop in PADD 2, a drop in PADD 5, but PADD 3, you saw kind of that last slug of refiners come back after EIA with 378,000 barrels a day additional throughput. This will continue until about the second week of October as we have additional, downtime. And again, seasonal downtime. It's nothing crazy. It's just maintenance. So we will see, we think now that 88.1 is the peak. As we were saying last week, 87.5 could have been. We thought there might have been one more, but if not, it would have just kind of been a sideways move. Instead, we had a small increase. And now we'll start to see that decline. But it'll be gradual, because we're not coming from 97% into shoulder season. We're coming from 88%. So again, that move down is going to be very gradual. Could very well be sideways, but again, you're just going to see some of that decline. And if you look against the 5-year average, we're very much in line with where we've been in the past. And that will continue going forward. So then when we look at imports had another increase of 88,000 barrels a day. You can see, obviously, it was increased into PADD 3 of 137,000. PADD 4 was an increase of 107. Now, PADD 5 had a decline, but still remained elevated, as we do have a lot of crude sitting there in PADD 5 waiting. Obviously, as we talked about constantly in the Econ Show, you're going to keep seeing this lumpiness, but again, there's still a lot sitting there, and it's still 207,000 above the 5-year average. And then when you look at PADD 3, you had an increase of 137,000 barrels. That's something that we think is going to be a fairly continuous increase. And then PADD 2 had an increase of 7,000, but it's 172,000 below the 5-year average. And again, you're getting some of that noise when you look at line 3, what's coming through. So we will kind of get this big makeup number, and just think about like the more of a tidal wave where you pull back, create that line fill, and then you have that wash over, and you'll see that being a bit more consistent into PADD 2, because you're going to be relying on a pipeline and less on rail. You'll still have it on rail. It's just you're going to see a bit more of a steady flow given how it's being delivered. Now, just touching again on European gasoline, they slipped in the week through September 23rd, again, we're looking at here. And when you look at total gasoline arrivals in the U.S. from Europe shrank to 313,000 after being revised up to 383,000. So we see that being revised up a little bit, but not by much, just because we did get a bit of that drop. And we did get 435,000 barrels of diesel from Europe, and down from 720,000. And then jet fuel, we did get a small increase to about 300,000. So we're starting to see some of these products move around as Europe tries to balance what's coming into their market based on what's flowing from the Middle East and Asia. So then when we look at implied demand, as we were saying last week, we thought there was going to be a bit of a makeup number in gasoline, and we were assuming that it was going to be about 300,000 barrels a day. Instead, it came in at about 500. So we went from 8.89 to 9.39. So we were expecting to go to about 9.1, maybe upwards to 9.2. So there was that 200,000 barrel a day increase. Again, we think it'll just come back down. It's just it's gotten much lumpier due to the shortages that we've been seeing on truck drivers. Some of that residual, not much given, but that residual that was in from Nicholas, from Ida, that has now passed for the most part. So we will start to see some of this normalcy. And as we said last week, we thought distillate was going to drop by about 400,000 barrels, because we were saying that it's still going to be strong. And the reason why is when you look at what's happening in the distillate, especially the diesel side, there's a lot of demand, and that's going to, again, keep us above the 5-year average, keep us, well bid as we go through the shoulder season, as we do have that additional trucking, which we'll talk about in segment 2. Then when you look at jet, as we were saying, we're going to kind of hang in this level, about 1.4 million. That hasn't changed that much. And then propane had a small decline of 191,000 barrels a day, but still well above the 5-year average, still staying strong. And that will continue throughout the remainder of the year. So then when we look at floating storage, we're still on the low end, and it's just that you had some of that backlog coming through Houston. So now as we start to look out over the next few weeks, we expect to see some increases. And again, not back to the 5-year average, just increases in the sense where we're going to be, let's just say, higher than we've been through April of 2021, but still, again, below that 5-year average, but kind of well within the cloud, if you will, and closer to about, let's call it anywhere from 2.5 to 3 million barrels in storage on the offshore side, as we do have that wave coming that we've purchased from Saudi Arabia, from Iraq, as well as from West Africa. Now, when we look at the imports, and this is what we're talking about of kind of this makeup, on an import side, we're actually at the highest level of 2021 on imports into PADD 3. So you had this clearing, if you will, and this is one of the things that we were talking about the last 2 weeks. The numbers seemed a bit off. Like it seemed like from what we were seeing on the ground, when we look at tanker movements, there should have been a bit more imports. So this is a bit of a makeup. But again, as we've been saying, we expect to be below the 5-year average, but still remain at the 2020, near the 2021 highs, creating kind of that chevron pattern, if you will, and just going sideways from this point as refiners continue to target the distillate cut. And then when you look at PADD 2, we're still at the seasonally adjusted lows. We expect, again, this is going to kind of get this little pop up, and that's where we start looking at that 4-week rolling average. So we will see this start to increase as we go through the remainder of go into October and more importantly into November, which is going to keep us, as we've been saying, above the 5-year average. When you look at the average going back over the year, we'll have made a new high. So then when you look at just refinery utilization rates, you can see we're right within the noise, but at the low end. And one of the things that I want to call attention to, it looks very similar to Harvey in the sense of again, the severity wasn't as much as Harvey given the location. Ida was Louisiana, Harvey was Houston Ship Channel, Texas in general. So again, it's just a matter of how much refining is located in these locations. But right now, we expect to kind of go and move very similar to how 2017 played out, where we have maybe one more increase, but realistically more of a sideways move, and then a gradual move down as we come through kind of the peak shoulder season, if you will. So those are things that we're going to look at and talk about as we go into the next segment, talking about what's happening in refined products in terms of storage, in terms of demand, and how is shoulder season setting up, and what do we expect to continue to happen through October.